What about a garage? Because a lot of these guys, while they're in the growth stage,
Yeah.
they're storing their stuff at their home, in their garage, in their, how would that break down?
That's awesome you brought that up, because
So let's talk about purchasing equipment. What is tax deductible? What is not? Because there's guys that may go out and buy themselves a vehicle and they may sign on the dotted line, but not buy the right vehicle and not be able to take the deduction. So
Right.
these guys, we've got to pound this in. This is what you need to do.
I may be forgetting something.
Let's talk about a few of the IRS red flags that guys need to avoid. Common mistakes that guys may think they're okay on, but it's going to be a big in the IRS office. Hey, let's audit this guy.
Sure.
Because I was that guy. All right, guys, we're back today, and we're going to be meeting with my accountant, and we're going to be talking about IRS red flags. We're going to be talking about a lot of things that take small business owners under when they're very new in their business, but it's the same things that the big businesses absolutely know what they're doing, and it's how they get by. It's how they can manage to run multi-million-dollar companies and pay less in taxes than a guy that's got a pickup truck, a bunch of shovels, a trailer, and is busting his butt every single day of the week. And if you guys start to arm yourself with just the basic knowledge, which is the goal of this two-part series, hopefully it'll help you guys long term. I don't know. You guys got to tell me, was this, after you watch this, is this a good video? Comment down below. Give me your feedback. Without wasting more time, let's get into today's video. Let's talk about things, that the gray area deductions. Let's just be very frank, very open. Your home office.
Yep.
All right. How much of your home office can you actually deduct?
Yep. And just to say, I don't like the gray term as much. I usually say, and whenever I meet with people, I talk about, home office and mileage are kind of in a different category, because I don't look at your bank account and see a check for home office for mileage.
Okay.
So that's why they're kind of in a different bucket that you don't see out of pocket. People use the gray term, but I
don't know what the terminology is. I just want to make sure these guys are leveraging it.
Gray is, it's not. I mean, there's written rules, so it's really, like you said, there are rules, but there's different interpretation. Maybe there's different calculations, for the vehicle. If you're doing mileage, none of that other stuff applies, so I'll skip that. But for office, you already have either you're paying rent or a mortgage for wherever you're living. So for home office, if you have a dedicated office that you're doing, just for you, it's invoicing, whatever, that's where you work from. You don't have an actual office. So square feet of the office, just say like a room like this is 200 square feet. Your home is 2,000 square feet. Pretty easy calculation. It's 10% of your home then. Then you take if you're renting, your rent. If you have insurance, your insurance. You probably don't have repairs and maintenance if you're renting. Your utilities, if that totals up to $5,000 times that 10% calculation, then that's how you determine your deduction. Or if you have a mortgage, then you're gonna have more of a deduction normally, because you have your real estate taxes, mortgage interest, homeowner insurance, any repairs and maintenance you did to your home, and utilities, and then times your same percentage. There are some rules for office. To have an office like this, it has to be what they consider exclusive use.
Okay.
Meaning it's only used for an office.
What about
you don't have a treadmill and pull-out couch and.
What about a garage? Because a lot of these guys, while they're in the growth stage,
Yeah.
they're storing their stuff at their home, in their garage, in their. How would that break down?
That's awesome you brought that up, because different from the exclusive use thing is storage. So that can be your garage, another room in your house. That doesn't have to be exclusive use, but you can also take that portion that you're using for your home for storage.
How much? What's the percentage?
It's the same calculation, basically.
Because some of these guys have big garages, so that's a big portion of their house.
You could get a big deduction for storage too. And there's a simplified method as well for $1,500, which sometimes, we'll do that, if people, but I guess it just depends. I'll just ask people, are you storing stuff? Yes, half my garage, or some people are my whole basement, and So yeah, it varies, but storage does not have to meet the exclusive use, so that's a big deduction that I think people miss out on. You know, people always get nervous about, I don't want to depreciate my home, you know, but I don't take actual depreciation, but that is considered part of the office deduction, you know, as if you take that, is part of it is for the depreciation on that section of your home.
So let's talk about another strategy. Right now, what's going to be happening is the automotive dealers, heavy equipment dealers, these guys are going to get inundated with people looking at making purchases. And I'm one of those guys.
Yep.
The reason I'm here is we just spent an hour and a half doing my pre-season tax planning before we ever turned on any cameras whatsoever. So let's talk about purchasing equipment, what is tax deductible, what is not. I'm talking about automotives, and some of these rules are not going to apply when you guys are watching this video because it may be old by this time. So this is something to at least put on your radar screen, because every vehicle that's over 6,001 pounds goes into a different classification, which allows for a higher rate of, is it first year depreciation?
Correct, which is
Okay.
called the 179 deduction, section 179. If you Google that, there'll be tons of information. They even have their own site, section 179. But that was one of the things that changed with the 18 tax cuts, is raising that figure and just trying to, you know, promote putting more money into the business and pay less tax is what it's for, and that's what we use it for.
It's a business stimulus that the government
Correct.
actually has done to help small guys get by, but also to make new purchases. And can you actually tell us what this business deduction is so guys understand it?
What the business deduction is, so what the 179 is?
Yes, it's
So-
when you buy a vehicle, you can deduct 25 grand, right?
Okay, so yeah, just on the vehicles, you can take up to 25,000 on the 179 deduction if the vehicle's in the 6,000 to 14,000 range. You know, bigger vehicles, if you dump trucks, things like that, they're called no limit apply vehicles. Otherwise, if you buy a passenger vehicle, you cannot take as much of that up front, and there's a lot less of depreciation. So for contractors, if you're looking to buy a vehicle, if you're doing the mileage deduction, don't worry about any of that, because then it doesn't really matter what vehicle you drive, you get the same mileage rate. They don't have a factor based on the year you buy a vehicle. So it's another thing I look at too. If you're driving or if you're going to get a low price used vehicle, why would you ever take actual expenses and depreciate? Take mileage. You're
Yeah.
going to get way more, you know, than if you buy a 10,000 used or something.
Okay.
Especially you guys that are driving a bunch of miles.
Yep.
You know, 58 cents a mile for 2018, you know, is a big amount compared to. So you have to look at the whole piece of it on vehicles, and an important factor is every time you place a new vehicle or asset in a service, is when you decide how much you want to take for first year depreciation and spreading out the rest. And then likewise on vehicle, if you depreciate, you can't do mileage. Your next vehicle, you might decide, I want to do mileage. You can switch each vehicle, you just can't switch back and forth on a particular vehicle.
So let's get a little bit specific. So if,
Yep.
if a guy wants to bring his taxable income down, he's going to go to the car dealership and say, I need a brand new F-250 truck because it comes in over 6,000 pounds.
Yep.
Right? So 6,001 pounds. And he pays 40 grand for that truck.
Yep.
In the first year, he can deduct a $25,000 lump sum on federal.
And he can actually elect to take bonus depreciation as well, so he could take all of it on federal under the new tax laws if he's in that
When did that
range.
new tax law go in?
2018.
2018. So you could deduct all 40,000 in one single. So if
On
you guys
federal.
have an amazing year and you don't want to give Uncle Sam your money, go buy yourself a new truck, and that's going to bring your taxable income down.
And trailers, equipment, all that stuff. It doesn't have to be a vehicle, but that seems to that would probably be the most common, right?
It's
A work
common,
truck,
but-
it seems.
But we're talking about vehicles now because there's guys that may go out and buy themselves a vehicle and they may sign on the dotted line but not buy the right vehicle and not be able to take the deduction. So
Right.
these guys, we've got to pound this in. This is what you need to do. But if you go buy yourself a new lawn care trailer, you buy yourself a new skid
Right.
loader, 100% tax deductible the first year.
Correct.
If you want to. If you don't want to, can you then take a portion of that and then take the
Sure.
rest of it on in the following years?
Yep, vehicles are normally 5 years, so if you do straight line for the easiest example for your depreciation method, if it's what were we using, a $25,000 or $40,000 vehicle, so $10,000 a year. In its basic sense, I mean, it really spreads out over 6 because the year you buy it, it prorates by the months, and I won't get into all the calculation of it, but you get to deduct it all spread out then over basically 5 years.
Let's talk about some stuff that most guys probably won't think about, and that's their clothes.
Yep.
So their clothes, if they use those clothes, if they buy work clothes, because they're spending $200 on boots, they're spending
Yep.
$200 on bibs for working out in the winter.
Yep.
Even their clothes are deductible if you allocate them into the right category.
Yes, and that's a very good point, because this is something that people don't always do correctly, and of course there is a rule for it. Things you mentioned, fully deductible work boots, specialized, so I should define it first. Specialized work equipment, yes. Work boots, that's specialized. Now, for instance, myself, as soon as I get home, I'm out of my work clothes, but I can't deduct mine. These aren't specialized. I could wear these all the time. Just like for contractors, I've had some tell me, well, I buy jeans and sweatshirts to work in. Unless you put your company's name on it, you can't deduct those. Those are just normal clothes. That's how you dress to work. If you put your company name on anything, basically it's deductible then.
Okay.
So if you want to do sweatshirts and put, genetic landscaping or whatever on, or I could do law tax, and then I could deduct those items. Specialized equipment, work boots, glasses, ear muffs, helmet, work gloves, boots. I may be forgetting something.
Let's talk about a few of the IRS red flags that guys need to avoid. Common mistakes that guys may think they're okay on, but it's going to be a big in the IRS office. Hey, let's audit this guy.
Sure.
Because I was that guy, right? And I learned a few things the very hard way. And I don't want these guys to follow down the same path that I did.
Yep.
One of the IRS red flags that I can tell you is hiring subcontractors versus hiring employees.
Yes.
And that is one of those areas where there's actually a sheet of rules, and I think they have 21 different rules that for a person that you bring into your company, for them to be a legit subcontractor, they have to hit every single one of these rules. If they miss even one, they're an employee in the IRS, and the IRS rules all.
If you go through a payroll tax audit on that, yes, if you don't meet all the criteria, we found out, because I think they removed all of them except for maybe one from contractors, if I remember. And that's, the criteria, you want to go over some of the criteria?
Let's just touch base on this, guys, and let's give them a resource, because at the end of this video, we're going to tell these guys how they can get a hold of you, or they can at least have the basic understanding to look this up on their own, because we could spend an entire video on the difference between a contractor and a subcontractor.
Yeah, so you can Google it. There will be a list that'll be a pretty good guideline. You do have to be careful about trusting your source when you Google. Not everything can be trusted 100%. IRS.gov isn't the easiest to read. You can obviously trust that, though, if you read it there.
When I got audited, they went back years on me, and then they actually went through every single one of my records. She was a very, very nice, very thorough gal.
Yes, I remember it.
And she would get on the phone with every single person that I wrote a check out to. She did. She called and interviewed them, set up face-to-face appointments with them. They are thorough. This is something you don't want to mess around with. You've got to get this thing right. If you hire somebody as a subcontractor, they set their own hours, they bring their own tools, they set their own rates, they invoice you, they don't give you hours.
Have their own equipment, not using your equipment.
Right.
If you think of it like an entity, why do people start an LLC? Because you want it separate from Stan himself, right? For liability reasons. It's kind of the same as a contractor and employee. An employee is going to be tied to you. You're going to be setting all their work, your equipment, all that. Whereas a contractor, usually they give you a bid, right?
Mm-hmm.
And then you say yes or no. They kind of do the work on their own time. I mean,
there's so many roofing companies right now.
But that's kind of the basic guide, though. I try to keep them completely separate. They do their own thing. They're a contractor. Do their own thing, have all their own stuff. And if they work for more than just you, that's even better. That was another issue, that a lot of the subs were only doing their work with you.
Right.
And using your equipment, and you setting the hours were the main issues.
So I say roofing companies, siding companies, a lot of them bring on subcontracting crews. And these are guys that I want them to be aware of if they're just starting out. You are going, even though every other Tom, Dick, and Harry inside of those industries is getting away with it for now, eventually time will catch up. And when it does, it is one cruel son of a duck. I'll tell you that right now.
Yeah. And most of the time you're going to have to write a check, right?
Yes, you will. All right, what other IRS red flags are we looking at that, guys, I want these guys to have on their radar screen so they're doing it the right way?
Yeah, no, that's a great one that you mentioned for the small guys, especially when you start out. You're like, I don't want to have an employee. I'm just going to sub him. So that's a great point. The other thing, when you look at your return, I always look at it and make sure things make sense. You might not be able to do that, but that's why I just recommend having somebody do your stuff for you. So, I'll look, for your cost of goods sold, things should be certain percentages of gross profit. If you mark up on your jobs, right? Your gross profit should be positive. And then from there, your other expenses, things we talked about to lower tax, should be fine. But things should be in line. If they're not, if I'm an IRS auditor and I see, well, this guy spends more on his materials than he brings in for money, that doesn't make sense. He either doesn't know how he's bidding or he's hiding something, right?
Or he's just not bidding the right way.
Right, which could be possible, but over time, your things have to make sense, if one number's way, you want to categorize a little bit so that you don't just tell them, well, I had 100,000 of income and 50,000 of miscellaneous expenses. That's going to be a red flag for them. Well, why are they not giving me any detail? It should be, I've got 1,000 of office supplies, 10,000 of repairs and maintenance, or whatever.
They've got to break that down. So
don't knock yourself crazy over, should this be office supply or tool, but put a little bit of thought into, try to separate a little bit. The more information you give them, the less likely they're going to have a question, and nobody likes to get questions from them, right?
So let's do a recap. Let's do just a quick summary of what we've talked about so that these guys, we can nail this down. The first thing is, get yourself an accountant that knows you, knows your business, and then will actually take the time to be proactive and contact you.
I think so. I think I save people a lot of money that way. We have lists, and whenever there's a deadline, which this is a deadline business, whether it's payroll, taxes, income, corporate deadline, whatever, we're always reaching out to people trying to, hey, you're going to get a penalty, let's get this taken care of. And so, which again, people need that. Maybe not every place does that, but I know that's what a lot of people tell me they really appreciate about the relationship, is that we remind them of the things and you just do your work and let us do this part for you.
Yep.
So again, there's all different ways, and everybody works with different people different ways, so find the right person for you. But they should be asking you questions too, though. It's not just you giving them information. If these guys want to
reach out to you, Jeff, how can they find you?
Law, Tax, and Financial Services. We're in Woodbury, Minnesota.
Okay.
You can find our website online. My
What
phone number and email is there. It's either under lawtaxandfinancialservices.com, or the abbreviated is L as in law, T as in tax, F as in financial, S as in services, M as in Mary, N as in Nancy.com. Jeff at LTFSMN.com.
Right. Okay, so we've covered a lot of ground. This is the time of the year. Get together with your accountant before the end of the year. I had one guy bragging to me how he bought $100 and some thousand payloader after the first of the year, but he was able to convince, as part of his negotiation, person to backdate it to before December 31st. And I'm like, why are you bragging about this? That is just something that if you would have been proactive, that would have been not a negotiating point. You could have dropped him down another 5 or 10 grand on the overall cost of this machine. So be proactive, get in the office, do your tax planning early, understand what's deductible if you're going to lease, if you're going to buy, how much deductions you can make, what you can actually deduct, what can't be deducted. These are all huge points and a large portion of the overall success of any small business owner that's out there. I hope this video has helped you guys out. Is there any last thoughts you have, Jeff?
No, I think what you're saying is great points, and you know, it's just like I wouldn't go out and try to do my own landscaping. You got to have somebody to take care of that part so you can focus on what you're good at, building your business.
Right. All right. Thanks, Jeff.
No problem.
That's what we got for you guys today. You guys probably remember Jeff from before. Yeah, Jeff and I have worked together. I worked with his dad beforehand, so this is, I vetted these guys the best in the business as far as I'm concerned. So you got questions, you can ask them, but you don't get to steal them from me, plain and simple. That's why I even said that to him beforehand. I'm like, just make sure that you have enough time left for me. That's it for today, guys. God bless. Go get them, and do me a favor. I'm going to pop up a video over here. I'm going to pop one up over here and tell me what you think of this video, because I need to hear from you. Do you guys want more educational videos? Do you want more hardcore stuff like this? Does this help you guys out? That's the goal. I started the channel to help you guys out. I want to continue to do that, and sometimes it's a matter of getting together on a video like this, and other times it's a matter of trying to mow over a mower with another mower. You know, sometimes we have a little fun.
You'll have to send me that one.
God bless. Go get them, you guys. We'll see you on the next one. All right, guys. That's all we got for this 2-part video series on accounting. I know accounting is not the most exciting topic to talk about, but I think it's one of the most important ones. And now after you've watched this, my whole goal was for you just to have enough basic knowledge to go out and be comfortable vetting different accountants. Be comfortable while you're running your business, the day-to-day operations, knowing where you're at, what's deductible, what's not deductible, and it'll help you understand strategies long-term. I hope this video's helped you guys out. That's all I want to accomplish with it. Let me know if I succeeded in the comments down below. God bless you guys, and go get them.